Hey Trenton, can you hear me?
I sure can.
Perfect. All right. You said that you're home now and able to like grab a pen and paper?
Yeah, just give me one moment. I need to
Yeah,
find it.
take your time.
What can I use? Yeah. Okay. Okay.
All right. So, um, perfect. So first thing, I want to just let you know, first part of today's call, I just want to get an understanding of what the situation looks like. And then, there's over 35 companies, bunch of different products. We'll look at which one actually makes the most sense for you guys. And then I can tell you about that, obviously. Um, so just to start, we'll take down my name. That way you have it. It's Tyler, Tyler. Last name is Glennon. It's just like John Lennon, but there's a G at the beginning there. So Glennon.
Okay.
And then this is my cell number that I'm calling you from today. So whatever we end up doing here today, if you guys want to adjust, change things, you can feel free to call, text this number. This is same number that my mom calls me on, okay?
Okay. Good to know.
All right. And then last thing, my national producer number is something that's just tied to all my insurance licenses, and they just require that I leave it with you because it's a really highly regulated industry, okay?
Okay.
That's just 2020
All right.
1576. All right. Now, let's just start here. I know that the mail card that you had filled out and sent back said mortgage amount is 159, just about. Is that correct?
Yeah.
Okay, so that's how much you owe on the loan still, right?
Yes.
Okay. And then do you have an idea of how much equity you guys have?
Equity?
Yeah, do you know how much equity you guys have?
Not off the top of my head, no.
Okay. And did you guys just move in to the home?
Yeah. Officially started moving here this past week.
Okay, very cool. Is it a typical 30-year loan? Gotcha. Okay, 30 years. And then let's see. Interest rate, what'd you guys get on the loan?
Believe it was 6.37. Oh, I have the paper here still left out.
Okay.
Yeah, 6.375 is the interest rate.
All right. And then what's the home appraised at?
I believe it was 164,000. I think
Got it. Okay.
it was priced exactly at the price of the home, 164.
Okay.
One sixty four. Okay. Yeah, 164.
Gotcha. And then did you guys do a normal conventional loan? Put down 3%?
Yes.
Okay. All right. So let's see here. 6.75%, 30 years. And then what are you guys paying per month for it?
My most recent payment was it's like 1333
Okay.
75 cents.
And then do you put anything extra to it each month?
As of right now, I have not. No.
Okay. Gotcha. All right. So got that all down here. All right. And then your guys' income, is it you and someone else in the home as well?
Yeah.
Okay. And then I guess you guys both working.
Yes. I'm the one who's paying the mortgage, though.
Okay, so you're paying the mortgage. Gotcha. And then income wise, what would you guys be bringing in each month?
Uh, hey, what would you say you bring in each month? Yeah. Right now, like, I have probably like 1,200, but it's gonna go up here soon. Yeah, 1,200 as of right now. 1,200, but it varies so much since it's seasonal. Oh, yeah. Oh, it's seasonal. I have, and then mine is about, hey, next month I'll probably bring home like this. Yeah. Mine is about, I think it's about 2,300 a month.
Gotcha. Okay. And then most people, Trenton, are, I guess, mainly just trying to make sure if one spouse loses their income, something happens, it's not going to be a financial burden on the other one to stay in the house. Is that mainly what you guys were looking for here as well?
Yeah, pretty much.
Okay. All right. And then I know I have your info, Trenton Post is your last name, right?
Yes, POST.
And then what is the lovely lady's name as well?
Aubrey Kirsch.
Aubrey, gotcha.
Do you need help spelling the last name?
If you could, that'd be great.
All right, so it's spell my first name. Aubrey,
Okay.
and then Kirsch. There's like a million different spellings. I know.
That's funny. Okay, perfect. All right. There's a couple different directions I think that we could go for you guys. Let's take a look here. Medically, do you guys take any kind of medications? Are you guys pretty healthy? I know that you're on the younger side.
You do have yeah, the bare minimum is a sertraline medication. That is the only thing that I take.
Okay. And then what would that be for?
Anxiety.
Okay. All right. And then smokers, non-smokers.
Non-smokers.
Okay. Good. Happy to hear that.
With smoking.
Okay. All right. Well, good. The pricing of the programs will be based off of three simple things. Age, you guys are really young, which is great. Health, you guys are really healthy, which is great. And then typically the last years, or excuse me, last 10 years of health. And then the amount of coverage that we'd be looking at and just what your program will actually look like and how it's going to help you guys, which we'll kind of get into here in a second. Um, most of the questions that I've asked so far and everything else that I'll, cover and talk about is really just mainly to make sure that I'm pulling up the best programs for you guys. Cause like I said, there's a lot of options out there. So all we want to do is just make sure that whatever we look at, number one, is going to make sense while you guys are still here because we don't want it to pull too much out each month from your pocket, as well as if something does happen to you or one of you guys, you guys are not leaving each other in a bad spot. Okay. Now, have you guys thought ahead at all? I know you just moved in. You probably, these probably aren't thoughts that had run through your head, but have you guys thought about if something did happen to one of your guys' income, would you guys want to stay in the home?
We would like to. I think how we have it now is that I'll be paying for the mortgage and then she'll be paying for like the groceries and whatnot.
Okay.
So
In his name, I'm paying all the spare expenses at the moment since he's bringing in more.
Okay. Gotcha. Okay. Understood. All right. And both you guys working full time right now, right?
it technically works part-time.
Okay.
Yeah,
You work like 38 hours.
it's technically a part-time job, yes. But I also do seasonal work, so outside
Okay. Gotcha.
I work
Full time. Gotcha. Okay.
off, so
Okay. Understood. And then Trenton, what are you doing for work?
I am a lab technician in Columbia.
Gotcha. Very cool. And Aubrey, for you, what do you do?
She works at
I work part-time at Dollar General, and then in spring and fall, I work in a nuclear plant.
Gotcha. Very cool.
No set one though, so
Okay.
I can't get where.
Gotcha. Okay. All right.
am I coming in quick? Make sure.
Yeah, it sounds good on my end. Little in and out here and there. But all good on my end. You guys hear me okay?
My internet's doing fine, but I don't have it just solely set on my internet, so I think it might be connecting to my cell service, and it's not very good down here.
Okay. Gotcha. Okay. So right now, I guess if your guys' income was to stop, would you guys be able to continue to make mortgage payments?
If we were to one of us, is it just? I think if I were to, stop, probably not. Yeah, it would be a lot more difficult.
We have to have everything transferred, basically.
Yeah.
Since my name's not on it.
Yeah.
Okay.
Feeling
Okay. And I guess like what would you guys do if something did happen to your income right now, Trenton?
Well, I do what any person do, start applying at jobs to try to get some form of income going.
We'd probably put my name on it.
Yeah.
Put my name on stuff so I could start.
Making payments.
Yep.
Instead of having to just transfer money to me and then pay it.
Right. And I think that we can all agree, guys, right? Like quality of living, standard of living, if one of your guys' income, even if it was Aubrey's, were to disappear, life would look a little bit different day to day, right? Making payments, kind of running around, trying to, keep the ball rolling on the financial side, right?
Right.
Okay. So that's something that we can look at to try to make sure we add a little bit of extra security. And like I said, since you guys are so young, cost wise, you guys are in the best time to be able to do something like this. Now, if you can grab that pen and paper, I want you to write down a couple extra things for me. The first thing I want you to write down is going to be a number 1. And then just kind of next to that, I want you to write down mortgage. And then we'll just take down the full loan amount with that. So mortgage and then the 159,000. Okay. And then so the second thing that I want you to write down is going to be equity. And I know that you said, we put down the 3%, which isn't, a ton, right? But as you guys live in the house over the 30 years, your equity is going to increase. It's not going to turn into six figures tomorrow, but as time goes on, you guys will have equity in the home. Worst case scenario, without these programs in place, what happens to people is if something happens to one of your guys' income and you guys aren't able to continue to make mortgage payments, do you guys know how many months it takes for the bank to foreclose on the house?
No.
It's usually just a couple of mortgage payments. Every bank's just a bit different. Some it's one, some it's two, some it's three. And so what happens is all these months, all these years you guys make payments, you guys build up something called equity. Last thing that we want is for something to happen to one of your guys' income or both. You guys can't make a mortgage payment. The house gets foreclosed on and you lose all the equity because it's kind of like a savings account because you're building the ownership in your asset, which is the home. Okay. So we don't want to lose that. We want to keep that. Okay.
Sounds fair enough.
So that's number two. We're going to take down number two and equity. And then the third thing I want you to take down there is income. And then I want you to take down your total monthly income, which is that 3,500. And then I want us to take down Trenton's first, and we're going to write down the 2,300. Okay. And then Aubrey's then next to it, which is the 1,200. Okay. And right now, if we got sick, something bad happened, right?
Yeah.
We passed away. We weren't able to go to work and earn our active income because we have to show up to earn it. Like we all said earlier, would look a little bit different. Things would be a little bit more difficult to keep up the same quality of living, right?
Yeah.
Okay. Now, the fourth thing I want you guys to take down here is going to be, we're going to write down cash back. Okay. So since you guys are so young and healthy, from what I've gathered so far, you guys should be able to get into our highest tier plan, which is pretty special because not everybody's able to qualify for it. And basically, because the goal is to outlive it, right? We don't want to have to use the plan. And you guys are young enough where it really, does make sense to plan for the future like that. If you guys outlive it and when you outlive it, we want this plan to give you everything back that you've put into it. Okay. So it's called the cash back option. And you get a full refund once you outlive it. Okay.
All right.
All right. So all this stuff kind of makes sense so far, right?
Yep.
All right. So what I'm doing right now is I'm pulling up your guys' amortization schedule, which is basically future payments. And this just gives me an idea of how much you guys will owe in principal, a couple years left on the loan. And so what the idea is, and we'll kind of walk through the numbers on this stuff, but number one, we want to make sure that if something happens to you guys, your full mortgage gets taken care of. So the other one is not going to be in a position where you guys have to stress, worry about finances while they're mourning and grieving about losing. You guys would be mourning and grieving about losing each other. We don't have any financial burdens. Okay.
Okay.
Now, with that being said, let's just say, 15 years down the line, you guys have a solid chunk of equity in the home. We want to make sure that we protect that as well. Worst case scenario with one of these plans in place, you guys would be able to protect the equity in the sense of paying off the home. Now you own that six-figure asset. Okay.
Okay.
Or if you get sick, critical, chronic, or terminal illnesses, you're not able to go show up to work, earn your active income, you're going to get access to a portion of the money while you're still alive. Okay.
Okay.
Now, most people say that we work with at least that the home is their biggest asset. Is that what you guys would say as well?
Yeah.
Right. And since our income is paying for the home, I think that we can all agree here on the call today that if we didn't have our income, we wouldn't be able to pay for the home. So the income's probably something that we should make sure that we have protection on as well.
Yeah.
Okay. All right. So the way that I see this, guys, with Trenton's income being the majority, what makes the most sense to me is we start off by looking at a plan that's going to cover Trenton. This is going to be the most cost-effective plan. And actually, here's what I'm going to do. I'm going to pull up two options. And so what we'll look at here is going to be the plan that puts predominant amount of coverage on Trenton. And then we're going to have coverage on Aubrey as well. But since your income is, I would say, almost, close to 65% Trenton's, it's more important to make sure that Aubrey's going to be taken care of if something happens to your income, Trenton. Okay.
Yep.
I do have a question,
Sure.
because hopefully in the near future, at least, my income will become more than his. Is that something we should consider at this time while we're on this, or is that something we can take care of later when that does happen?
Yeah, absolutely. So what we would do is when your guys' situation does change, you guys can give me a call and we can make any adjustments that we need to when that day comes. Okay.
Alrighty.
And so right now, Aubrey, how young are you?
I'm 20.
What? Okay. All right. So since you guys are so young, like I said, these are going to look pretty great rate wise. What we're going to do is we're going to go through two different choices. Um, we'll kind of cover the numbers on both. Um, I'm guessing, guys, it's probably not a matter of whether or not we need to grab one of them, right? It's just going to figure out which one is actually going to make the most sense per your budget each month, right?
Yep.
Okay. So let's do this. Let's write down a 1 and a 2 here. And what we're going to do is we're going to look at a plan that is going to be, the first one is going to be 160,000 for you guys each if you guys pass away. Okay. And then I want you to take down under that, and this is option number 1. If you guys have any kind of critical, chronic, or terminal illnesses, it's going to give you access to $144,000. Okay. And then we're going to set this up so in 25 years, if you guys outlive this again, which is the goal, in 25 years, you're going to get all the money back at the end of it. Okay. So you're going to get a full refund of $39,900. Now, what most people do at this time is they use that to pay off the rest of the home. Okay. Which can save you almost, it can be for you guys. I'm looking at it. It's probably going to be, $7,000, $8,000, $9,000 ish in interest because you get that full refund. Okay.
Okay.
So this is option number 1. Okay. Option number 1 is going to be $133 a month. Okay. So option number 2 is going to be a little bit less in coverage amount. And it's going to be 62% of the total amount that you guys have left on a loan, which is 100,000. Okay. Same idea, the 10 years, or excuse me, same idea. It's going to be 25 years. Okay. And let's see here. Let me make sure I got this all plugged in here right for us. All right. So all right, we're going to take one step back here. Just want to make sure I got these numbers plugged in here right for us. 20 female. Okay, so why does that? Sorry, guys. Give me 1 second here. Just want to make sure my numbers are right. Okay. And then, yeah, so we're going to go over to the $100,000 option, which again is 62% of your loan. So if something happens to you guys got mortgage payments for a while, you can pay down a large amount of the principal right then and there to lower the mortgage payments. But we're going to buy you guys some time if something happens. Again, worst case scenario with one of these plans in place, you keep the home, you have enough time to be able to sell it and move on and downsize. Or you can pay majority of the loan off because over time you guys are going to pay that down either way. Okay. All right. So this option is for 62% of the total amount on the loan. It's $100,000 in coverage, which means that if you guys have any kind of critical, chronic, or terminal illnesses, it'll give you guys access to the 90,000 while you're still alive to be able to make mortgage payments. You guys can go to the grocery store. You can do whatever you need to keep on living your normal life. Okay. And with this one, you guys would be getting back $25,900 at the end of the 25 years. Okay. And this one's only going to be $86.50 a month. Okay. Now, is there any reason at all why the $86 a month would be too expensive for you guys?
I don't think so.
Okay.
There's not that's in my eye that makes it seem that it's too expensive.
Got it. Okay, so I'm going to pull up this option here. We'll start you guys there. And then if you guys want to adjust down the road, like we said earlier, we can always do that. Now, can you guys just verify the spelling of, I guess we did Aubrey's already. Trenton, can you just spell your first and last name for me?
TRENTON and then POST.
Okay. And then a ballpark on each of your guys' heights and weights.